back, the passive income investors alike to my favorite monthly paying dividend stock of all time. In fact, my favorite real estate investment trust of all time, and generally the largest holding in my dividend stock portfolio, making up over $30,000 in value, paying me over $150 a month. Yes, I'm talking about Riocan here, folks, which is still trading down 30% from its all-time highs, and there is a drastic shift happening in Canadian real estate right now, and I'm going to explain to you why I still think this company is a severely undervalued REIT, considering it's Canada's largest REIT here, folks. But before we dive down into that, if you appreciate the homework I do for you, if you enjoy these Canadian real estate videos, consider hitting that like button, folks. But let's kick this off by zooming out and talking about Park Lawn Corp. Why? Well, we're going to take a broader view of some other REITs because, man, oh man, there is a lot of recovery going on, and this is a REIT people are dying to get into. It is a graveyard stock. They smashed earnings in 2020, and they've seen a full recovery here, folks. Pretty incredible. What about the industrial sector? Like when we're talking about logistics and shipping and things of that nature, full recovery in the Canadian market. What about office space? Everyone thought was a waste of time and money, but look, even Kevin O'Leary sold his office REITs, but here's a pure office Canadian REIT, fully recovered. And yet when we scroll over to Riocan, a well-diversified with malls, they're getting into condos, they've got millions of square feet that are going to be coming online over the next few years. It is trading down 29%. Now, this primarily became my favorite real estate investment trust of all time because it sits in my backyard, my home city of Toronto. And I understand this market very well. So we're going to be getting into some recent news this company came out with that I think will really shine a light on why I think it is so undervalued at the current rate here, folks. But before we do, they did cut the dividend, guys. They have seen a bit of a decline, obviously, in their earnings through 2020. They are nothing like Park Lawn or logistics. No, I'm not saying in comparison when we're talking about revenue and earnings, but if we're talking about a valuation standpoint from where it sits today and where I think this company is going to be in the future, it is trading at a relative discount to its peers. So going from 2019, they did $1.36 billion in revenue. Going into 2020 through the whole pandemic, they only did $1.17 billion, and it looks like they lost earnings, but they did a lot of write-downs on buildings and obviously tenants they were having issues with. So it looks like they made no earnings, but I always recommend that you look at the funds from operation because that's how we know that their dividend is sustainable. And I'm promising you they can afford the dividend even before they cut it. They're just doing it for security purposes. But when we take a look, their underlying assets, which I think are going to be greatly valued differently in 2021. But in 2020, they had about $15.26 billion in assets against their liabilities of $7.5 billion, which have been creeping up slightly over 2019. But the most impressive thing, guys, is if we minus these out, that means they have about $7.6 billion in underlying assets. Yet the stock currently trades for $6.2 billion, which represents about $1 billion in disconnect from that underlying asset value. But before we get into the most recent news that I'm finding like exhilarating and just absolutely incredible, because what I should do is go out and actually take some photos of these or videos of the real estate that I'm interested in that Riocan operates. Let's just hear what is going on in the city of Toronto with real estate right now, folks.
You can add to that the current interest rate environment. We just got some fresh numbers on what's been happening, and Greg Bunnell joins us now with a scorecard, if you will, on what was happening as we wrapped up 2020. Greg, take it away. Just give us a sense on what exactly we have seen in this home market frenzy.
Yeah, despite the pressures of the pandemic, John, and we know that the market just froze up in the Greater Toronto area along with everything else in March and April, they have just booked in the Greater Toronto area in terms of home sales their third best year on record. It's pretty astonishing considering millions of jobs were lost in the early innings of the pandemic. Our GDP cratered. Obviously, we saw a big bounce back, and there's a lot of talk about the K-shaped recovery, the fact that this pandemic did not hit everybody equally. And people who were in a position to buy real estate were not hit as hard as others. These numbers really tell that tale. The third best sales year on record. And then you talk about what you saw in December. You and I had this discussion yesterday morning around this time about Vancouver having a strong December, Toronto having its strongest December ever. I had a chance yesterday to talk with Steve Soretsky. He's a realtor in Vancouver. I'm hearing the same things from realtors in Toronto as well as I speak with them about the fact that they were working on deals. I had heard Christmas Eve Christmas Eve. They were still taking offers on Christmas Eve. Steve Soretsky in Vancouver telling me yesterday it's not the way he wanted to spend his Christmas Day, but he was closing a deal on Christmas Day. The activity was just frenzied into December as well, giving Toronto a record. And if people were looking to get into the market and they thought perhaps a global recession, a pandemic, massive job losses might actually mean prices came down, prices ending the year at $932,000 on average in Toronto. That is a new record. And that's the month of December. If you smooth it out for the year, still a record rise in prices in the Toronto market.
Whoa, baby! I mean, like, this is unreal, guys. I was talking about this in my video the other day, just driving around and looking at this supply and demand issue, because for some reason, real estate had a hard time moving through 2020, and then out of nowhere, in the last 3 months, real estate has spiked 20 to 30%. Average homes went from like 800,000 to over 900,000, and ghetto homes were selling for like over $1 million in Toronto here, folks. And why am I telling you this? Well, because again, Riocan is highly focused in premier properties in downtown Toronto, and one in particular that I want to talk about because they just released a news article on is obviously The Well. This is one of the most premier properties in Toronto. It is a brand new build that is coming up. I can read you the little description. Just read this. The Well is the most ambitious mixed-use endeavor in Canada, located in the heart of Toronto's West End, bordering Front, Spadina, and Wellington, those streets. The design includes 1.1 million square feet of office, 500,000 square feet of retail, food, and services, and 1,700 residential units spread throughout 6 buildings connected to 3-level retail basis. So what I've told you guys is Riocan sees the future of real estate being mixed-use buildings. So basically, if you work for a company, you might be able to work in the same building, rent your condo, and use the shopping mall downstairs. So they're trying to build like literally living centers that offer these full vertical kind of, integrations to life. Now, this comes online. Does it show here when exactly it comes online? Because I think it's in the next year. This property is going to become fully available, at which they just released a full announcement that I'm going to read through really quickly because man, oh man, there's a lot going on here. So we're just going to skip through this. Reading the bottom. So situated at Front, Spadina, and Wellington and spanning more than 1 million square feet, The Well will be a vital component of King West. This interconnected mixed-use development will introduce, along with new residential housing, a relevant urban streetscape of retail experience and concepts in approximately 340,000 square feet of indoor and outdoor space. It will also offer workspace solutions for thousands of users across 1.2 million square feet of office. So they recently, to date, Riocan has executed leases for approximately 110,000 square feet of the space dedicated to an exciting new opportunity to eat, shops, and experience at The Well. This represents more than 1/3 of the conventional retail space, including the Wellington market at The Well. So apparently food approximately is making up 60,000 square feet. Health and wellness is making up approximately 24,000 square feet, and everyday services around 10,000 square feet. This is what they currently have, I guess, booked. Now, they're claiming that negotiations and discussions with prospective tenants that will also contribute to the overall character of The Well continue to make progress. First possession of the retail space is anticipated by 2022, so in a year from now, folks. But more impressively than not, this is what blows my mind. The office space at The Well is now 85% leased to Shopify, Intuit, Finance IT, Index Exchange, Spaces, Quadrangle, and Conrad Group, among others. Initial tenant possession remains on track for the third quarter of 2021. With increasing momentum, the remaining office space is expected to be leased up promptly. The main office building has reached height of 36 stories and is on track to be topped off in May 2021. 6 residential buildings, including the towers that Tridal and Woolbourne will develop on their own, will be home to 1,700 condominiums and purpose-built rental suites. Construction of the residential buildings are well underway, with housing options for young professionals, growing families, and empty nesters. Tridal has already pre-sold 83% of its condo inventory, further underscoring the desirability and demand for these mixed-use communities. Now, guys, this is insane. A lot of people have a lot of issues with Riocan because of the past performance of the stock, because obviously for like the last decade, the stock itself is relatively flatline. And this came to a lot of shift in management discussions and how they wanted to see the future of Riocan, because before like the 2008 financial crisis here, folks, Riocan was highly focused on developing and expanding into the US. They were continuing to grow into malls. And then one day they woke up and realized, heck, Amazon is going to ruin our life. So we're going to sell off the vast majority of our malls. We're going to liquidate all of our US properties. And you know what? We're going to highly focus on where we understand. Being Canada's largest REIT, where do we know people are moving? Where do we know the future is? The city of Toronto, baby, my hometown. And they decided to liquidate those properties, take tens of millions and millions and millions of dollars. And let me go back in here, and they pumped it into the development projects. Now, these shouldn't be taken as underwhelming projects. These things are massive. The Well alone should be an exemplifier of their capabilities, being one of the more premier properties in Toronto, but they still have Strata, they still have Luma, Rhythm. These are like the Ottawa properties. So these development properties, in my opinion, are the most premier in the major cities of Ontario, with Toronto and Ottawa. Now, the Oshawa one I find rather interesting because Oshawa is more of a coming up city, so they might see some growth there, but clearly Toronto is where the real insanity is going on here, folks. So if there's one thing I'm really grateful for, and the thing that I'm going to be looking forward to, guys, is basically these projects coming online and watching those revenues go back up. And more than likely, my opinion, over the next year to 2 years, we're going to see that dividend recover. And I'm super glad, instead of selling out of this thing when it crashed, when Kevin O'Leary was like run for the hills, I averaged down. I was buying in the 14s, the 15s, the 16s. My average buy price right now sits right around $17 because I did start before the crash happened buying into Riocan. But when you compare it to its peers across all sectors, guys, this might be one of the few REITs that is actually seeing the fastest growth in its underlying asset value. Because again, if Toronto real estate just went up 20 or 30% in value literally in the last 3 months, what does that do for something like the Well? I mean, that is a tens of millions of dollars property. So I'm going to be very excited, guys. I'm very excited for this company, and I want to pass the question off to you. What do you guys think about Riocan in that comment section below? I cannot buy any more of it. It makes up 12% of my entire portfolio. The fact that I don't own real estate, the fact that I never plan on buying real estate, I am just because of the over accentuated price. Because like I said, the average home right now in Toronto is $900,000. So I'm not in a rush to move out by any means, but at the same time, I'm glad that I feel like I can get a discount to Canadian real estate through Riocan, because like I said, if this stock chart looked like anything like real estate actually looks like, it doesn't make any sense for it to be trading down to its 2008, 2009 level lows. So I'm glad of all of us, folks. Stay cool, stay awesome, and I look forward to catching you tomorrow.